I posted three research notes this week. The first one was about oilfield services margins, and specifically the margin deficit that Baker Hughes has experienced relative to SLB, Halliburton, and now Weatherford. And what I looked at was the difference between the margin on products sold versus the margin on services delivered. For all of these companies, the margin on products sold is at best equal to, if not considerably below, the margin on services delivered. And with Baker Hughes, the product margins are the weakest. So that's step one. That's bad news for Baker Hughes. The other step that's bad is that Baker Hughes gets about 60% of its total revenue from product sales, whereas SLB, Halliburton, Weatherford get 40%, 30%, somewhere in that range. And so not only is Baker Hughes's product margins lower than its competitors, but they also get more of their revenue from product sales. And that combination means you have this 6 to 8 point margin gap that you see that has remained for years at this point. So that's sort of the bad news, but the good news is embedded in that, which is it is clear what Baker Hughes needs to do in order to close this margin gap. It's also clear, given Weatherford's margin expansion recently, that these kinds of gains can be had. And if Baker Hughes realizes the full extent of closing that gap, that's $1 billion opportunity for them. So it's an exciting opportunity possibility ahead for them, but it's a real challenge given what their financial performance looks like today. My second post was about petroleum refining, and we were looking at both crack spreads and then margins for three of the largest independent petroleum refiners in the U.S. Valero, Phillips 66, and Marathon Petroleum. What we see is that crack spreads are coming down off the highs that we saw coming out of the pandemic. And as a result, the margins for these three operators are right in line, falling to the same extent the crack spreads have fallen. Now, these crack spreads are normalizing in a sense where they had been before the pandemic, where we saw them in 2018 and 2019. That's where we should expect margins to go as well. They may be a little bit higher now because there's just been operational improvement across the sector. The point is, this post pandemic bounce was incredible and worth celebrating. And investors and management teams absolutely took advantage of it. And it is very much coming to an end. So now we're getting back to the kind of operational regimes that we had been used to before the pandemic. And that means new realities for each of these refiners as they get into some pretty difficult cost allocation decisions. My third post was back to the oilfield services side. We got Weatherford's full year 2023 results this week. And I showed what has happened to Weatherford's revenues, margins, again, relative to SLB, Halliburton, Baker Hughes. And what we see is this margin expansion story has absolutely been resilient. It's continued. Weatherford's margins are pretty closely tracking SLB's margins. Both of them are a shade behind Halliburton. So there's still opportunity for further margin expansion from here for Weatherford. Its year over year revenue growth is basically either first or second place amongst this group of four for each of the past 3 quarters. And that's pretty impressive because for the 5 quarters before that, they were consistently in third place. So they're growing revenue better than they had. They're growing revenue better than most of their competitors in this group. They're expanding their margins. There's a lot to celebrate there for Weatherford. And the question then becomes, of course, as we go into 2024 and North America continues to be pressured and the oil field continues to lean into offshore and international markets, will Weatherford be able to continue this momentum? So that's where investors and management teams, employees, everyone is keeping their eyes on that story. Those are my three posts from this week. Each weekend, I send out a free weekly newsletter that I call the Business of Energy. All of my posts are about how energy companies are making money, how they've made money historically, what the future prospects look like for them. I do it for a bunch of energy industrial companies. Like I said, it's a free newsletter. I include links to summaries of all the research that I post online in each week. I also include an energy related anecdote, insight, or observation that I only share in the newsletter. So that way, even if you've seen all the stuff that I've been sharing online, there is still something new in the newsletter for you. So totally free. I will put a sign up link below. As always, thanks a bunch for reading, watching, liking, commenting, all of it. And stay tuned for more. I will see you next week.